Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and on this special edition, we're going to be focusing on the kind of impact the removal of the 2000 rupee notes has had on the liquidity in the banking system, on the currency in circulation, and what that means for the overall economy at large. Joining in to understand more insights on this, I have with me a very special person on this show. Mr. Vivek Kumar joins in. He's an economist with QuantEco. Welcome, Mr. Kumar, and thank you so much for taking the time out for this discussion. Now, important takeaways that we're getting from the reports that have come out is that currency in circulation is down 36,000 crore rupees in just 1 week post RBI's 2000 rupee move. Now, help our viewers understand what does this really indicate when the circulation or the currency in circulation really reduces?
Thank you, Sakshi, for having me over on the show. That's a very pertinent question because this is the first set of data which has been made available post the May 19th announcement of 2000 rupee note withdrawal. So this is probably the first dipstick that anybody can do ever. Now, currency in circulation is something which tells you that what is the amount of currency which public at large withdraws from the banking system. If it is coming back to the banking system, what it tells you that people are depositing more on a net basis than withdrawing on a net basis. So roughly 36,000 crores, as you rightly put out, this is for the week ending May 26th. So this is exactly the first week of the announcement of the 2000 rupee impact. And typically it happens that if you analyze all the months in a year, typically the first half of the month is generally where you see currency going out of the banking system. The second half of the month, you see typically currency coming back into the banking system.
Okay.
On a net basis, there are certain months in which currency goes out on a net basis. There are certain months in the year in which currency comes back into the banking system. Now, May traditionally or seasonally has been a month where currency goes out of the banking system. It does not mean that all the weeks of May currency will have to necessarily go out. Typically, the last towards the end of the month, you'll see some bit of inflow back into the banking system. Now, 36,000 crore of inflow, does that justify the seasonal pattern? I think it does not. Anywhere between 5 to 6 or 7 odd thousand crore of inflow would have been a natural inflow back to the banking system, which you could have associated towards the end of the month. Now, since the number is 36,000 crore, you could possibly say that roughly 5-6,000 crores is something which is organic. Roughly 30 odd thousand crores is something which is inorganic or something which is not natural. So that is or can be ascribed to the impact of 2,000 rupee note withdrawal.
Understood. Now, I'll take this point forward as well. Another data point that we have received is that surplus liquidity in the banking system, which had earlier dwindled, earlier part of this month, has now swollen past the 1 lakh crore rupees mark. And that's over the last couple of days. What would that get attributed to? Is that also a reason or a resultant of the 2000 rupee note withdrawal, or is there something else to it as well?
Well, that has a direct bearing because if let's say your currency in withdrawal is declining, which means there is inflow into the banking system, so it will get reflected in the higher liquidity numbers. And if I can just take a step back, on May 19th, when the announcement was made, the systemic liquidity was roughly 66 odd thousand crores. The systemic liquidity or the banking system liquidity as of 31st of May is roughly around 1,67,000 crores. So there has been a 1 lakh crore addition to systemic liquidity since the day of the announcement. Now, is everything attributable to the 2000 rupee withdrawal note? Well, I would suspect not, because a lot in systemic liquidity or the banking system liquidity is also governed by what the government is doing on the spending and on the revenue collection side, as well as what the central bank is doing in terms of its FX operations. Now, if we were to make an assumption that RBI was by and large away from the FX market in terms of intervention, then to a large extent, this 1 lakh crore addition to systemic liquidity is either on account of 2000 rupee note withdrawal or it has been on account of government spending. Now, what is the evidence? Now, in terms of evidence, one is obviously the currency circulation data that we have. That is for week ending May 26. So that clearly shows that roughly about 30 odd thousand crores is attributable to some form of inorganic increase in systemic liquidity, which can be attributed to 2000 rupee note withdrawal. The other
Okay.
part is the government spending. So Sakshi, what happens is typically government pays out salaries, and government also carries out a lot of month end spending. So towards the end of the month, maybe just the last day of the month or the first working day of the next month, you'll see a gush of liquidity, which is on account of government spending, which is traditionally kept towards the end of the month, or maybe it gets spilled over to the first working day of the month. Now, how much of it is attributable? I guess probably more than 50%, according to me, would be attributable to government spending, and
Okay.
maybe less than 50% can be attributable to 2000 rupee note withdrawal.
Okay. Now help our viewers also break it down further that, what would this liquidity boost really mean for the banking system and the economy at large now?
Sure. So there are two angles to it. One is obviously more is the liquidity, more I would say free flow of funds would happen. It's something which is good for interest rates in general. It's something which is good for banking system in general. Now, where does it stand in the current context? Is a high liquidity or a surplus liquidity something which the central bank would be comfortable with? Well, we all of us know that the central bank is currently in an inflation fighting mode, and the
Yeah.
monetary policy is currently designed towards fighting the inflation breach that happened in the post-COVID environment. So the recent inflation numbers do suggest that there is an emerging degree of comfort, but the RBI definitely is not going to let down its guard on its inflation fighting mandate yet. So where does liquidity picture fit into this? We would expect RBI to keep liquidity somewhat on on the tighter side. By tighter, we don't mean that liquidity would be in deficit. By tighter, we would mean that liquidity would be tighter compared to what it was last year. So in some sense, incrementally, the liquidity glut would be much lower, or the liquidity surplus would be much lower, according to RBI's comfort level. What is that comfort level? There is nothing which has been defined as per law, but typically RBI associates 1.5 percentage points of NDTL, which is the banking system deposit base. So anything above 1.5 percentage points of NDTL in terms of liquidity surplus, RBI associates as inflationary. Now, in terms of rupee crores, what does that mean? In terms of rupee crore, it would mean anywhere close to 2.5 lakh crores, give and take few thousand crores here and there. But 2.5 lakh thousand crores ballpark number is something that RBI would probably keep an eye on. Anything above that on a sustained basis would be considered a dilution of its inflation fighting stance at the current juncture. So typically, if that were to happen on a sustained basis, you can expect some sort of central bank intervention to mop up the extra amount of liquidity, which can be temporary, which can be completely transient because of the 2000 rupee note impact. All of us are expecting the 2000 rupee note impact not to have a durable or a permanent impact on system.
Right. So again, I want to just want you to expound upon this further. What is the impact of more liquidity surplus in the banking system with the RBI on inflation? Currently, we are seeing the inflation levels cooling off. What will this extra money really do to the inflation levels?
So till the time liquidity is lower than 2.5 lakh crores, a ballpark number I'm giving you, which roughly corresponds to 1.5 percentage points of NDTL, RBI probably will not be bothered much because it does not really dilute its inflation fighting stance. But the moment it starts moving above 2.5 lakh crores, I guess
Okay.
that is where the RBI could get uncomfortable. And that is where the RBI probably will start exploring options. Some of those options can be in the form of, sucking out the temporary liquidity through variable rate reverse repo auctions. It can introduce a sell buy swap on the USD INR front to temporarily suck out liquidity and maybe give out liquidity again, maybe 6 months down the line or 9 months down the line, when the system kind of normalizes in terms of its liquidity.
Right. And as you also pointed out that we are inching towards the end of the rate hike cycle. We've already seen a pause from the RBI. We are awaiting the next policy decisions. The US Fed is also likely to give out its decision, even though the US continued to maintain its the increase in the rates that it followed, because it did say that the war on inflation is not over, and similar is the stance for the RBI as well. So what would this increase in liquidity mean for the interest rates going forward from here, both for the depositors and for the borrowers as well?
So the simple correlation is that rates are going to come down if, let's say, there is the assumption that RBI does not intervene. So in the absence of policy intervention, you'll see cooling off of interest rates. We've already seen that the short-term rates, whether these are one-year rates or less than three-year rates, they have cooled off much more than the longer-term rates. So by longer-term rates, I would mean anything above 10-year duration or above. So that has already happened since the time the announcement came. Now, if liquidity continues to increase and the RBI does not intervene in the process, then you could see further cooling off of interest rates.
Okay.
Now, as I said, we would not expect this to continue because we would expect RBI to come at some point in time if this sort of behavior continues. So let's say if you continue seeing liquidity impact of 2000 rupee note in the week, in the coming weeks, then you could see some sort of policy intervention because it does not really gel well with the RBI's current inflation fighting stance.
Okay. Have you already seen some impact on the money market rates? Have they dropped at all because of this liquidity? And can it further bring down the cost of borrowing for both the government and in turn for corporate entities as well?
Well, it has already done at the short end of the curve. So by short end, I mean people who are borrowing via short-dated instruments, whether the government is borrowing via treasury bills, or whether, let's say, the corporates are borrowing via certificate, or the CPs, or the banking system is borrowing via CDs. All the short-dated instruments, typically short-dated instruments would be 12-month or less. All those instruments have seen interest rates come down in the last 10 days. Now, can they fall further is a question. If this continues, definitely it can fall further. Will they be allowed to fall further? I guess that's a more relevant question. And to us, what it looks like is that temporarily there will be a downward pressure, but the central bank is going to resist that through various instruments.
Okay. Since I asked you this earlier that, what is the breakup of this 1 lakh crore rupees, kind of a liquidity boost that the government, that the RBI has now got or the banking system has got. And you said that more than 50% would be government spending and less than 50% would be accounted to the 2000 rupee notes. Going forward from here, the original estimates were that now that these notes will be withdrawn, I think the money in circulation was somewhere to the tune of 3.6 lakh crore rupees. So are we going to see that eventually happen till September? What is your own sense of the kind of liquidity boost that we will continue to get going forward?
So this is one question, I guess, which everyone will keep guessing on till September 30th deadline comes into play. But as you rightly said, 3.7 lakh, 3.6, 3.7 lakh crore is the outstanding, or was the outstanding before the announcement of, before the May 19th announcement. And depending upon what is the behavioral outcome of economic agents, depending upon, let's say, how much of this money was actually kept out of circulation, while it was technically in circulation, but it was not practically in circulation or not actively in circulation. So
Yeah.
if there was a motive which was entirely, which can be entirely mapped to, let's say, a preventive holding of currency, then that currency will come back to the banking system on or before September 30th. It will also get back to circulation again, maybe in the form of 500 rupee note or whatever denomination, because that was predominantly held with the motive of prevention, or there was some precautionary motive behind that. If there was an angle of, let's say, avoidance of tax, or if there was a black economy angle behind the hoarding of money, then maybe a little bit of money can, on a durable basis, come back to the banking system. Now, what is that share which will be much more sticky with the banking system? That is anybody's guess. So we did a simple scenario analysis at QuantEco Research, and we ascribed on the lower side 10%, let's say, if the deposit were to be durable, turn out to be durable, then what is the liquidity impact? And then on the higher side, if 30% of the deposits turn out to be durable, then what is the liquidity impact? So between these two ranges, uh, the number actually turns out to be 40,000 crores on the lower side and 1,10,000 crores on the upper side. So anywhere between this can be the liquidity impact over the next 4 months.
Okay. There was also an anticipation that apart from the liquidity boost, the currency which is in circulation even now and which hasn't been returned to the banks, and because the time span is about 4 months, more people may be wanting to, spend it rather than getting into the hassle of going to the banks and exchange it and or deposit it. Even though, because we have already come to know about a lot of senses that per household there are only a few notes that are available and not many, so it's easy for them to spend it. So what impact have you already seen in this last 1 week of the kind of consumption, the trends that we have seen, and what is the likely impact going forward going to be then?
Now, unfortunately, we don't have very high frequency data on consumption, and so that makes the guessing part on consumption really challenging. You'll probably get some bit of idea maybe a month or two down the line, but anecdotal evidence, whatever media reports that one reads, gives us the impression that at least in the urban part of the country, there is a surge in terms of consumption, and these consumption can be classified as high value consumption items, whether this is going out or maybe buying precious metals or maybe getting into the real estate sector or maybe buying an expensive automobile, whatever that is. So there is an evidence of that also happening. There is an evidence also, data is also telling you that nearly 30 or 1,000 crores came back to the banking system. So both are happening simultaneously. Now, to what extent, as I guess the final question is, even if money gets back into the banking system, if it will eventually get exchanged, and maybe a large part of the money will get withdrawn again. The moot question is, what is that share of money which will come back to the banking system on a durable basis? So that is something which is entirely undecipherable.
Sure.
Whether it is 5%, 10%, 50%, I guess it's completely a guessing game at this point in time. So we think it could be anywhere between 10 to 30%.
All right, something durable would be 10 to 15% of the kind of deposits and the liquidity boost that the government, that the banking system is likely to have benefit of over the period of time. Well, many thanks for giving us all those insights, Mr. Kumar, and being with us on the show to help all our viewers understand what to make of this kind of a reduction in the circulation of the currency and also the impact of the liquidity boost that we are looking at into the economy. Many thanks. It's been a pleasure speaking with you. And with that, we wrap up this special edition, but do stay tuned on to Business Today TV as a whole lot more comes up right up on your screens.
Government as a